Hi everyone, welcome back to the final session. I hope you guys, the last half, but not quite yet the final session. Sorry for that slip of the brain. The chair for this afternoon changes once again, and I'm very pleased to have Ray Eskenazi, who's heads up tax for Sasol here with us. He's in the middle here. And I'm just going to introduce Ray very briefly. He's headed the global group tax function of some 30 tax professionals for Sasol for 11 years now. And the company has some form of business presence in 35 countries worldwide. He's an admitted attorney of the High Court of South Africa and has postgraduate qualifications in both tax and company law. Prior to joining Sasol, Ray spent a total of 14 years as an international tax partner with two of the big four accounting firms. Ray has lectured in international tax at both the law faculty of the University of Johannesburg and the accounting faculty at the University of the Witwatersrand. He has also authored several articles on international tax issues which have been published both locally and internationally, and has acted on 2 occasions as the national reporter for South Africa for the International Fiscal Congress. So, Ray, thank you very much for joining us.
That CV pales into insignificance when you hear some of the CVs of our speakers we got this afternoon. One tends to speculate why you've been allocated a Friday afternoon session at the end of a 3-day conference. There are 2 schools of thought. The first school is that the majority of delegates here generally would have called it a day by this time. And if these speakers are not up to scratch, it's not such a serious issue. Second school of thought. In an effort to ensure the retention of delegate participation right until the very end, and thanks for that nod there, Michael. And Des and I were just saying we're quite amazed this number of people here on a Friday afternoon. So what you do is you hold back your most interesting speakers until the final session. So we won't ask you at this stage to vote on which proposition you support. Anyway, welcome to this session, which has a particular focus on the Tax Administration Act and corporate tax issues. We've got 4 experienced tax practitioners who are going to navigate us through the provisions in the Act relating particularly to the administration of corporate tax, including SARS's powers to gather information, issue assessments, and preserve confidentiality. We're also going to touch on the rights and remedies of taxpayers in circumstances where these powers are not exercised in accordance with the provisions of the Act, or where SARS and the taxpayer adopt differing views in relation to either the interpretation or to the extent of these powers. Right, our first speaker is Des Kruger, who's sitting on my right here, still with his coat on, as formal as he normally is, a tax director with Ernst & Young based in Cape Town. And Des gave me carte blanche to summarize his CV, because if he hadn't done so, it would have curtailed his presentation by at least 20 minutes. Right, so let's go. Graduated from Harvard with an LLM and also attended the international tax program there. Des, did you pass? Because you didn't. Okay. It wasn't clear from the CV. Maybe you can just have a look at that element. 9 years as a deputy director with SARS, 15 years as a partner with Deloitte, 7 years as a tax partner with Weber Wenzel. A technical advisor to the Margot and Katz commissions. Those are commissions on tax for the younger participants here. Co-author of various publications, but including, very importantly, Bloomberg on tax strategy. Past member of the Income Tax Court. He's presently an associate professor of tax at UCT and has been recognized by various international publications and surveys as a leading tax lawyer in South Africa. finally, and most importantly, his real passion is for wine. Des has just produced his first vintages in the Swartland, where he lives near Malmesbury. Despite various promises, I still have to taste them, but apparently in the next week or two, a bottle or two will be forthcoming. And I hope to be in a position to confirm the quality in the not-too-distant future. But having said that, his first white release was awarded a 4-star platter. So congratulations, Des. Right, I'm going to hand over to Des now, and he'll highlight the 15 things corporate tax advisors, in his view, should know about the Tax Administration Act. There seem to be a lot more there, but I'm sure Des is going to stick to the 15 most important. Thank you very much. Here's Des.
Jumbo. I just got back from Tanzania last night after a couple of days holiday in Serengeti and Ngorongoro and Lake Manyara. And the Swahili know how to simplify things. They say jumbo for morning, that's good morning, jumbo is good afternoon, and jumbo is good evening. That's true simplification. This act is not a simplification at all. Now, when we're discussing what to do this afternoon, kind of confusion in terms of corporate tax. I kept on saying about corporate tax, VAT, all these things are dealt with in the same thing. So what do you mean by something separate about corporate tax? Kind of came to the idea that what we're going to do, if the one is about tax practitioners, the other one must be about in-house corporate tax advisors, who are in-house, let's put that, tax executives. And that's what I've tried to, limit myself to this afternoon. You've also spent the last nearly 3 days looking at various aspects of the Tax Administration Act. And I think at this point in time, you probably know more about the Tax Administration Act than I do. So what I'd like to do is in some sense, maybe go over a lot of the territory that you've already gone over, try and highlight some of the things that in my view and in my experience, in-house tax practitioners are really responsible for. Unfortunately, it is so, and certainly Ray, I'm sure, can confirm that it's the in-house tax advisors who are the engine room, really, of tax and tax administration in South Africa. We as consultants get called in and assist and that sort of stuff, or give you opinions on specific aspects, but the day-to-day administration that is so overall affected by the Tax Administration Act are you. And so what I try to do is highlight some of the areas that I think you've already touched upon. I no doubt you've touched upon it, but just once again, just by repetition maybe, and maybe giving you a different view on it, just highlight some of the areas that I think you need to be concerned about. The other thing, at the time I said there were 15 things. When I started doing the slides, there's 15 themes, you just have to find them. Okay, so it's clearly more than expected. Now I'm going to also tell you something that nobody else has told you. Okay? That up until the Tax Administration Act became effective, it was an offence to assault a person involved in administering VAT. It was not an offence to assault somebody involved in administering income tax. The good news is, right, that it's no longer an offence to assault anybody who's administering tax at all. Okay, you're just not allowed to hinder them. Now, I don't know if you blixen them, if that includes hindering them. So some of you might not have known that, some of you might have been depending on it. It's a section I used to use regularly when dealing with VAT people. I say you're obviously relying on this section because I want to climb across the table and blixen you. But anyway, so I remind them now that it's no longer there, that I can, in fact, assault them. The other thing that struck me about the Tax Administration Act is that when you sit cold and you read it, because everybody will tell you the tax, or SARS and whoever drafted it will tell you, all they did was pull everything together. Maybe I just didn't spend enough time looking at these administrative provisions previously, but it seems to me that what we have here is, in many respects, confirmation of the sometimes one-sided powers and rights and obligations of both SARS and the taxpayers, and very much in SARS's favour. Now, the other thing is, if you as corporate tax advisors, the other thing you'd be concerned about is making sure that you meet all your obligations in terms of the Tax Administration Act, the Income Tax Act, the Value Added Tax Act, or whatever it may be. Or else, like Google, like Amazon, like Starbucks, you'll be needing to explain to some standing committee of Parliament why you pay so little tax. Now, I don't know if any of you watched the Google interviews or whatever it was with the Standing Committee of Finance in Parliament in London. And they had the guy from Google there, no tie, no jacket, well, a jacket, very cool, flagged by 2 tax partners from Ernst & Young, trying to explain why they pay no tax in the UK. And that's obviously not where you want to be. You also don't want to be in a situation where you have missed the boat in terms of some of the opportunities you have to, in fact, enforce your rights. And that's something that we as South African taxpayers, consultants, in-house tax people need to start taking to heart. Because there's so often that we don't understand what our rights are in terms of, if it says you've got to do something within 20 days, then let's push them for 21 days. The problem is if you push, right, and they don't react, what do you do then? And those are the things I'm hoping that Andrew and other people will be able to tell us what we need to do, because it's really frustrating. And I also think if you read it cold, there seems to be a disjoint between the provisions and the draftsmen and the people who had the policy, took the policy decisions, and the foot soldiers. Often what we see happening in practice bears no resemblance to the provisions that we see here in front of us and which you've been listening to for the last day and a half. Okay, is this thing? There's a green button. No, I'm not going to push that button. Oh, is that it? Let's see if we go. Yes. Okay, so what are the things that you as internal tax advisors or tax executives, as I like to call you guys, around registration returns and records? And this is just highlighting some of the issues that I've come across in practice, and it's been many years that I've been in practice, and Ray's been a little bit behind me, I think, but we've been in tax for a long time. And these are the sort of things that I come across where people just aren't getting it wrong, or that have highlighted for me, reading it cold again, the Tax Administration Act that we need to be concerned about. One of the things that struck me is that there's a requirement to communicate changes in registration. And I had a client recently who got into trouble because that exactly hadn't happened. Now the trouble wasn't because if they say to you, you must alert them to changes in registration details, etc. They don't say what happens if it doesn't happen. You've got to then default to the offences thing, and there's a section 234 that says to you, if you don't do certain things in terms of that's required in the Act, it's an offence. But there's a practical aspect here, and that is that the returns or the communications that were taking place were going to the wrong address. And so by the time the taxpayer realized that it was one of the subsidiaries and it hadn't gone back to the head office, etc., all these time periods and everything had passed, and there was a huge problem. So this is something that it's a record-keeping thing. It's something that you need to be able to tick off to make sure that all your subsidiaries, all your affiliates, etc., where you are responsible for the tax function, that you have your particulars right. And you're required to let them know within 21 business days of that change. Now, the return must be full and true return. Okay, now I assume you're all doing the full and true return. That's not to be confused with the non-disclosure of material facts that arises when we talk about the limitation of reopening assessments. This is just a general requirement that your returns must be true and full and true. And I assume that once again on that circumstance, and on this basis, that if there is a basis that SARS could argue that your return wasn't full and true return. And I haven't been drinking my own wine before I got here, by the way. But anyway, that's another story. It's fun making wine. Okay, then the return must be signed by the taxpayer or a duly authorized representative. Now, what's interesting here, if it talks about the taxpayer or its duly authorized representative, there is no definition of who is a duly authorized representative. Clearly, we know in the context of a taxpayer, in the context of a company, we talk about a representative taxpayer, and that is usually your public officer. But who is a duly authorized representative? This is a taxpayer or duly authorized representative, and we see this throughout the Act as well. And in the debates that I've had with some of my colleagues, it's around what is meant by duly authorized. And the only thing the way we understand it, is that SARS is looking for you to have some power of attorney. If you are not the public officer and you get somebody else to sign it, just make sure that you at least have this power of attorney that either is available from the SARS website or one that you've received from your lawyers.
I could mention it in the SMS as well. But I'm not sure you're right about the authorization. I think it needs to be an authorization for that audit. I don't think it's general authorization, because why need it then? If the three of us are going to be authorized to do audits, Or is that just a way of trying to make sure that I go out there and do an audit and I'm not qualified to do it? I thought it was more, had to be, that inspection had to be authorized by a senior official. That's not yet existent.
No, they do exist. It's just the list is just not published. So with effect 1 October, the decisions that were required to be taken by officials, I contend that they did happen. Maybe prove it different in some instances. This is our interpretation, that you don't need an authorization for every audit. I mean, there is an argument that you need a specific authority to audit the taxpayer X. You can't just decide that day. I feel like auditing the cell phone company because they gave me a hard time, etc. So that is the counter-argument, that for each taxpayer you audit, it must be approved at some higher level. But the current interpretation is that will be too protracted, and therefore auditors, there are governance over them. They can't just decide, but that's an internal measure. But the authorization is general. You are an auditor, but as to which companies you may audit, that's determined by your team leader or by your manager.
Okay. Thank you. Thanks for that clarification. Any other questions? Maybe I could just make a few concluding points. Des spoke about a full and true return. Right, just make sure guys complete the right return. Understand there's a new return now which can be compiled on the e-filing system. Understand there's new CFC disclosures as well attached to that return, and the transfer pricing and thin capitalization sections of that return are now more comprehensive. I think that was released a couple of days ago. So just make sure we complete the correct return, because I understand that's applicable immediately.
I haven't seen it on personal returns.
Pricing section, is that also attached
No.
to personal returns?
To the best of my knowledge, I've only seen it in the context of the corporate return.
Yeah, because the problem obviously, is that many people take out the 4 million allowance and then they set up offshore structures, and obviously, transfer pricing takes place. And nobody, or the vast majority of individuals, are not really aware of their obligations in this regard. And I found that very few of them really sort of complete a proper return, especially as far as the transfer pricing obligations are concerned. And to add insult to injury, I understand from somebody, a senior sales official told me a while ago that their systems still do not link people who apply for tax clearance certificates to externalize the exchange control allowance to that particular taxpayer, because one would expect that if that was possible, they would immediately made inquiries if foreign income is not reflected in individual tax returns. And this is, in my view, a serious sort of, discrepancy in the whole system.
I suppose that gives rise to a whole other argument on full and true disclosure, as well as prescription periods. But anyway, that's interesting in the personal space.
Yeah, but the fact of the matter, if your return, if I remember correctly, your personal return provides for foreign income. Now the question is, that deemed interest that you have to disclose with regard to your transfer pricing exposure, if that must be disclosed as foreign income, and if you do not disclose it, what would be the consequences? Can you argue that you didn't make, or that you did make a full disclosure, if there's not a specific sort of question asking about transfer pricing? But anyway, it's a concern.
I think you'd battle to argue for disclosure, whether it's imputed or deemed. The mere fact that there's no question there, I don't think would relieve you of that obligation. And then, yes, one more question there.
On that new electronic IT14, the IT14 SD comes as a normal attachment to that. So
For
it's not
everybody?
like- yeah,
Does it?
apparently they don't just send it out anymore. It's part of your return.
thought it
But
wasn't.
like I said,
I thought it wasn't as
I
well
thought it
because
wasn't.
I know most of the smaller taxpayers were receiving the 14 SD. In our group, we haven't received, a couple of our smaller subsidiaries have. I don't know if...
No, I'm saying as part of this this new RT14.
Do you think it's automatic?
Apparently, it's
an
like
attachment.
annexed to that, yeah.
Really? I didn't see it.
Sorry? You haven't seen it?
There you have.
All right, well.
I requested a return a week back after they launched the new return.
Yeah.
And it was just a return, and there's a new thing called the Reg 01. The interesting thing about that, previously, if you updated the public officer, you had to send in the IT77. Because we just got a new company in, they told us that the IT77 is no longer in use. I need to go onto the Reg 01, complete the detail in there and update it there. They're not processing the IT77 which we submitted before that.
Okay. Thank you. I think the point you want to make is just watch the space with the new return and new requirements and new disclosures. Right, Des, thank you very much. Oh, thanks. Right, let's move on. And I'd like to introduce you to the youngest of the three gentlemen, Andrew Walstead. When Andrew's not dispensing tax advice, his music takes priority. And he's a member of an accomplished rock band, believe it or not. On weekends, he rakes up even more kilometers on his motorbike, now that his beloved Golden Lions are not taking to the field that regularly. Although they've got an important match tonight, Andrew.
This wasn't what I sent you.
I know. Anyway, Andrew is the national head of Norton Roses. Can I add Fulbright Jaworski next to it?
Yeah.
Not Fulbright Jaworski's tax department in South Africa. A couple of highlights from his CV. He's got a master's degree in tax, further qualifications in capital gains tax and mining tax. He's a part-time lecturer in the HDIP and Masters in Tax courses at the University of the Witwatersrand. He's described in the international publication, The Legal 500, the 2013 edition, as practical, commercial, and consistently delivering quality tax advice. He's authored numerous articles dealing with a wide range of tax and exchange control issues, and serves an important and impressive base of domestic and international clients. Andrew will highlight for us the important provisions relating to assessments in terms of the Tax Administration Act. Thanks, Andrew.
Excuse me if I'm a little hard to hear. I do have a little bit of a cold. Ray, I don't know where you got that information from. I won't deny being a Lions fan, but I do blush when anyone brings it up. I'm going to be talking to you today about assessments. Now, this function was nothing more than a date in my diary, and then I got an email from Ray saying, pity you got the graveyard shift. Sorry about that. And then I looked and I realized it was Friday afternoon. I then realized that I had to talk about assessments, which is about as interesting as watching paint dry in some circumstances. But I was heartened when I arrived, and several of the tax nerds that I met immediately said, are you talking about assessments? Have you ever thought about this and that and that? So in fact, there is actually some interest out there. I found it quite interesting in preparing. Unfortunately, the bulk of the interest is in the minutiae, but it could be very significant going forward. I also want to just issue a disclaimer. I'm a lawyer, and I now head up the tax team at Norton Rose. So I don't do returns, and I very rarely deal with assessments. So if you've always wondered how to fill in Part C, Block 328, Code 4, I promise you I don't know. So unfortunately, I'm going to be coming at this from what is the legislation. Let me see if what I think about when I try and interpret it, what are the practical problems. I don't really know much about doing returns. I don't know if Des or Ray. So, it's more of the legislation that's written down than the numerate implications of it. So as I said, I'm going to talk about assessments. Now, how can we make this interesting? I'm not going to bore you. I'm not going to spend hours on it. At a high level, not much has changed. We all know what an assessment is. It's easy to understand notionally. You get told how much tax you have to pay. We've still got the same sorts of things. You're going to see estimated assessments and additional assessments and reduced assessments. And those things haven't changed. So what are we going to talk about? Well, what has changed is the way that these things are dealt with. And one of the themes I'm going to be coming back to throughout the talk is that you had that much legislation before, which has now become that much. I think it's called simplifying legislation. I'm not sure that it always gives you the desired objective. And these simplified sections actually, on certain readings, give SARS sweeping powers to do things. Now that's all well and good. Assessments is about as innocuous as you can get, I would guess. They're telling you how much tax you owe on the face of it. But the problem is we've recently been involved in a large litigation matter with SARS. And if you start putting all of SARS powers together when they got it in for you, and I think many of us have one particularly prominent taxpayer to thank for a lot of these provisions, but when SARS are coming at you, they have significant powers. And if they use all of these powers in tandem, and if you have raised their ire sufficiently, you are batting off the back foot the entire time, as we'll see. So the way that I'm going to approach this, I'm going to tell you a little bit about my understanding of assessments in the old Act. I'm going to focus on VAT and income tax because we can't really talk about all of the taxes that are covered. I put up a slide. As you know, the purpose of the Tax Administration Act is to consolidate provisions so that the admin side of the tax covering a number of fiscal acts is consolidated into one act. That's true of assessments as well. Obviously can't go into great detail on each of the acts that are covered, so I'm going to talk mainly about VAT and income tax when I want to give any examples. So are assessments important documents? And if they are important, why are they important? Well, they're really the document. So your return starts the ball rolling when you're interacting with SARS about your liability for a particular year. But a lot flows from an assessment, and I'm not going to preempt myself. One of the sections that we're going to talk about is what are the implications of being assessed, and we're going to talk about that later. But an assessment is a very important document, and increasingly so or being assessed is very important, increasingly so in the new regime. So I think it's important to just give a sense of what we dealt with previously, what are the rules now, and then we can try and highlight what the differences are and if any of the differences concern us. The first thing is that an assessment under the old Income Tax Act, the historic position, it was defined in Section 1 of the Act as a determination by the Commissioner by way of a notice of assessment of an amount upon which any tax is leviable, an amount of any such tax, any loss ranking for a set-off, any assessed capital loss, includes any determination by the Commissioner which is subject to objection or appeal. So you can see it's telling you what the quantum of the tax that you need to pay is. What did we have? We had standard assessments that we're all used to. You'd put in a return, SARS would come back and they'd say, I see the information you've disclosed, I've done a computation, this is how much I believe you owe. We also had estimated assessments, and this is one that we're going to talk about under the Tax Administration Act a bit more, but they've been around for a long time and you can see why. It's obvious that in certain circumstances SARS is not given sufficient information by taxpayers, but they can't simply leave the tax outstanding because the taxpayer doesn't provide the information. They need to have the power to issue estimated assessments, and historically, and certainly from an income tax perspective, it's been where there was a default in furnishing a returner information, or the Commissioner wasn't satisfied with the returner information. where there were several sections, in fact, that dealt with whether or not the Commissioner believed that a resident had declared or accounted for funds held in foreign currency or foreign assets, and we'll see that that's completely gone. That focus on foreign currency and foreign assets, I'd suggest that was a hangover from a previous regime, so that focus has fallen away under the new estimated assessments. The estimate of taxable income was subject to objection and appeal. However, if you couldn't give the SARS official that you were dealing with any information or sufficient information, you could come to an agreement, and that wasn't subject to assessment or appeal. Okay, then there was a thing called an additional assessment. When would an additional assessment be raised? That would be raised if the Commissioner was satisfied that any amount which was subject to tax and should have been assessed to tax but has not been. There was an amount of tax which was chargeable and should have been assessed but has not. Tax which is chargeable and has become payable otherwise than under an assessment has not been paid, or an amount is owing. The section also contains certain prescription rules, which we're going to talk about later. So again, additional assessments, not rocket science. Where an assessment had been issued or no assessment had been issued, but new facts came to light, the SARS required the power to issue an additional assessment to make sure that all tax was paid. On the flip side of that coin, there were reduced assessments. Though these could be used when the Commissioner was rectifying a processing error made in issuing an assessment, or where the Commissioner was satisfied that in issuing an assessment, an amount was taken into account in determining the tax liability that shouldn't have been, or was not taken into account when it should have been, provided that it was issued based on information provided in the taxpayer's return. Again, these are all fairly logical consequences. You put in a return, the Commissioner assesses what your tax due is. If he didn't get it right the first time, he can issue an additional or he can issue a reduced. Finally, sometimes you could withdraw assessments. The Commissioner may withdraw an assessment which was issued to the incorrect taxpayer or in respect of the incorrect year of assessment, and they must withdraw an assessment in respect of certain insolvent estates, and a withdrawn assessment was deemed not to have been issued. So I don't think there's anything that anyone's unfamiliar with in the income tax rules about assessments. And as I say, you're going to see those same labels flowing through. What I'm going to try and do is just highlight some of the differences and why they're interesting. From a VAT perspective, just to close the historic loop, Section 31, an assessment wasn't defined in the VAT Act, funnily enough, but Section 31 allowed the Commissioner to make an assessment in certain circumstances, where a taxpayer fails to furnish a return, where the Commissioner wasn't satisfied with the return, where the Commissioner believes the taxpayer is liable for a payment that has not yet been paid, if a person represented that tax was charged on a supply but they weren't a vendor, if a person obtained an undue tax benefit and he purports to be entitled to a refund. So these were circumstances in which a VAT assessment could be issued. In ordinary courses, we all know how VAT works, self-assessment, and we'll see that in a case that we talk about just now. It wasn't required that an assessment was issued frequently. So let's just pause there. Assessments are fairly simple. They're a document that SARS issues to you setting out your tax liability. They can be adjusted by an additional or they can be reduced. They can be withdrawn. This is all common sense. What is interesting though is if you pull up your LexisNexis tax cases and you put in assessments, you'll be amazed at how many cases there are on assessments, estimated assessments. What was an assessment? Did the Commissioner do the assessment properly? There are tons and tons of interesting cases. So the first point that I want to make before I take you through these cases is that even though conceptually this is a simple process and a simple document or a simple type of tax concept, it's been contentious. The second thing I want to point out that in my view, given that there hasn't been a seismic shift in the whole concept of what an assessment is from these cases that the Tax Administration Act has consolidated, these cases are still going to be really very relevant going forward. And that's great. There are a lot of them. They help us interpret the law properly, even though the law is arguably all new, although it's based on something else. And they give significant guidance to the court. So let's talk about some of the things. I'm not going to go into great detail on these cases. The point was to illustrate what has been contentious and to put forward my proposition that these cases will remain forward when you're dealing with the issue of assessments under the Tax Administration Act. So ITC 1740 it dealt with an STC liability, and really what happened was that the taxpayer claimed that they hadn't received an assessment and therefore there was no tax due. I'm simplifying the fact significantly. What the court held, though, is that an assessment required at least a purposeful act so the commissioner had to make an assessment or a determination of the income and, as we saw in the definition, notify the taxpayer. So what the court found here is that indeed SARS had to issue a document embodying the mental act that was intended to be an assessment. So it wasn't simply enough for the commissioner to make a determination in his own mind. He had to issue a notice. Now let's just bear that in mind. One of the important things under the Tax Administration Act is the types of assessments that we get. Some other interesting ones, South African Custodial Services. Many of you will be familiar with these cases. The taxpayer wrote to the Commission, and again the facts were fairly complicated, but the Commissioner replied in writing with a heading Income Tax Revised Assessment for 2001 to 2004 stating proposed adjustments. Interestingly, the letter also said assessments are to follow, but when the taxpayer took it to court, he said, and this dealt with whether or not a particular return had prescribed or assessment had prescribed, the court said, and we've all seen funny documents purporting to be assessments, the court said, on the balance of the facts, this thing looked like an assessment and the taxpayer was entitled to believe that it was an assessment, and thus it did interrupt prescription. So the Commission had argued that it wasn't a revised assessment, and fortunately, unfortunately, depending on which side of the fence you fell, the court disagreed. Notwithstanding the fact, the court did note that the one bit of evidence that militated against it being an assessment was the note that assessments were to follow, but the court dealt with that as being a purely documentary issue. Another interesting one, and I remember sitting around in the tax team trying to work out what the court was talking about, was First South African Holdings. So highly, again, we're talking about whether or not prescription had been interrupted by the issuing of a notice by the commissioner. And the court took, I'm not going to go into, we don't have enough time to go into the detail, and it was quite a short but interesting judgment. The court took, again, a very technical view of assessment. It went to the definition of assessment, and as you'll remember, the definition had 4 little legs that the commissioner could adjudicate on, and that would be an assessment. And it said, only one of these legs has been adjudicated on. That's the only assessment that has been interrupted. So again, the court took a very technical view, but what does the case show us? It shows us that even though in concept assessments are simple things, and historically have been, there has been a lot of dispute about what is an assessment. Have I been assessed? What are the implications of this assessment? What's covered by this assessment? The last one many of you will know is Metcash Trading. It dealt with that, went all the way to the Constitutional Court. And the court in that one ruled that SARS didn't, that was self-assessment. SARS didn't have to issue a particular assessment before the VAT liability arose, and VAT vendors have an ongoing obligation to keep requisite records, make periodic calculations, and VAT is inherently a system of self-assessment based on vendors' records. So, and there are many more cases dealing with different aspects of assessments, but as I say, what I want you to take away from it is there have been a lot of arguments about have I actually been assessed, despite the simplicity of the definition of assessment. What is the impact if I have been assessed, and what can I do with this assessment? So let's move on now to the Tax Administration Act. We've now painted the historical picture. Let's go forward now and see what the position is. It's defined in Section 1 of the Act as the determination of the amount of tax liability or refund by way of self-assessment by a taxpayer or an assessment by SARS. Okay? It no longer includes any decision by the Commissioner which, in terms of the Tax Act, is subject to objection and appeal. That was, as you saw, one of the definitions of an assessment under the Income Tax Act. That's no longer there. So it's this very simplistic definition that you see in bullet point 1. A date of assessment I'm going to come back to, if I may, because I want to jump to the next slide. So the first interesting thing is we've now got different types of assessments. They're all called, somewhat confusingly, and even within the Act, sometimes they're called an original self-assessment or an original assessment or self-assessment. The Act uses the terminology not meticulously, but I think it uses it adequately that you get a sense of what's going on. What are the original assessments? The first is assessments will be raised by SARS in respect of returns which are submitted which do not include a determination of tax due. You put in a return, it doesn't include a determination of tax due, you are entitled to wait, or not entitled, the next step is that SARS will issue an assessment in respect of that return. That's called an original assessment, but if you read, my reading of Section 91 is all of these are original assessments. That's why I've got them under that heading. But sometimes, and colloquially by certain commentators, that's called the original assessment. That's your income tax return. Put in certain required information, pop it along to SARS, they do a tax calc, come back with an assessment, written assessment. This is what you owe. That is the original assessment. Okay? Now, the second type is if you submit a return that incorporates a determination of tax due, that is also an original assessment. It's called a self-assessment. Sometimes it's called an original self-assessment, but it falls under the banner of original assessment. And that return that you submit that incorporates a determination of the tax due is an original assessment. Okay, so take VAT for example, you do a VAT calculation, put it in your return, when you submit, that is your assessment, original assessment. If no tax return is required, but tax must still be paid, the payment is also an original self-assessment. The payment of the tax is an original self-assessment. Okay. This, as a note on the following point, and I've already mentioned, there's some confusion around the terminology in the Act as to whether these are all original assessments. But if you read Section 91, my view certainly is that these are all original assessments. So you've got three types of original assessments. Let's pop back for a second. So the date of assessment, assessment issued by SARS a la income tax, the date of issue. Self-assessment with a return, the date that the return is required to be submitted. Self-assessment without a return is effectively the date of payment. There's also a concept of an effective date, but unpacking that is unfortunately going to just take us a little bit over our time. So, just to step back, we've covered one type of assessment, an original assessment. It has three components. What other types of assessments do we have? Well, there's a new one, a jeopardy assessment, and this has created a lot of commentary, and we're going to spend a bit of time on that just now. We've also got our old friend, the additional assessment. In this circumstance, SARS must issue an additional assessment if it is satisfied that an assessment does not reflect the correct application of a tax act to the prejudice of SARS or the fiscus. Now, what I've said there in my commentary is that, to me, that's not a significant departure from the income tax position, which had those four components when the Commissioner could issue an additional assessment. And that's because the broad definition of assessment to include self-assessments and payments of tax really incorporates all of those subpoints that used to be in Section 79 of the Income Tax Act. So I don't think that on the face of it, additional assessment is a massive leap forward or a massively contentious thing. The only thing that I would suggest is the following. The wording, reflect the correct application of a tax act. So now where does that come up? SARS must issue an additional assessment if it is satisfied that an assessment does not reflect the correct application of a tax act. Certainly covers the old tests. Was there a correct amount included? Did we bring to tax an amount that should have been brought to tax? But does this give someone who's analyzing a return or adjudicating whether or not an assessment is correct, the power to start bringing up things like the general anti-avoidance rule. Yes, your return is correct, but I don't think that it's the correct application of the Tax Act. It may be argued that that wording, which is completely new and we've never seen it in any of the other sections, the correct applications of a Tax Act, could be argued to give SARS assessors more scope to issue additional additional assessments if they don't like the circumstances or the way that a transaction was put together. I'm not sure that it'll win. The only thing I do want to say, and I'll say it at this juncture, there's lots of things that are uncertain about this Tax Administration Act, and they've got to go through the courts, and we can use the old court cases. The problem is that going to court and taking SARS on these issues is expensive, okay? And so the bulk of us represent corporate taxpayers, and we're involved with corporate taxpayers who can do it. It takes hours of management time, and it distracts one from the job at hand. So while it may be easy to say, well, you know, there's a little bit of a concern about the wording, we think if SARS bring it up, we can take them on. You know, that's not an ideal position to be in. And uncertainty in our law, we heard Keith Engel speak about it the other night. It's something that we all complain about a lot. But it isn't great that we're dealing with an act where we've got new phrases and new terminology used, and some poor bugger is going to have to take it to court to find out what it means. The second thing I want to say, and I'll say it now just so I can bear it in mind. The second thing I want to say is these sections, although they are replications of what we had before, additional assessment, reduced assessment, all those good things, they're much shorter. They've been condensed into simplified language, which is good on one level. But on the other level, when you are trying to work out, has this tax assessor done an additional assessment or a jeopardy assessment, more controversially, correctly? Let me look at the Act. There's not much guidance there. In fact, it's very difficult to work out. So what would my ideal position have been? If SARS want to make simplistic legislation that deals with assessments, then give certain criteria. I'm going to give you an example. If you look at section 164, the old pay now, argue later section under the Tax Administration Act, it tells you a senior SARS official may suspend payment of a disputed tax having regard to, and then it tells you all sorts of things: compliance history of the taxpayer, amount involved, risk of dissipation of the assets of a taxpayer. I think that's great. It's not an exhaustive list, but if I'm going to be subject to a jeopardy assessment, I'd at least like to have seen the bare bones of some things that the official must consider, so that I don't just get, in my view, there was a risk of dissipation of assets, or, if I give reasons, I didn't have certain things that I had to address. So that's one of my key criticisms of these sections dealing with assessments. They're shorter, they're briefer, but they don't give you any real guidance as to how these things are to be implemented, which means someone's going to have to go to court, and the courts are going to have to tell us, well, Mr. Commissioner, you should have considered this. It would have been just from an administrative law perspective to have considered that. And I'll come back to that point a bit later. So we've dealt with jeopardy assessments. We're going to talk about that. Additional assessment, you get a reduced assessment. That can be issued in instances where the taxpayer has successfully disputed an assessment. If there is an undisputed error in the assessment, the error can be due to SARS or the taxpayer's fault. Where there's been a settlement or pursuant to a judgment, it isn't a requirement that there be an objection or an appeal in order to reduce an assessment. So that's quite a sensible provision. Okay, estimation of assessments. This is again quite a sweeping power, but one that we are familiar with at least. SARS may now, based on an estimation, make an original, additional, reduced, or jeopardy assessment, and must do so relying on information readily available to it. An assessment based on an estimate may be done when the taxpayer fails to submit a return or submits a return or information that is incorrect or inadequate. Now let's quickly go back to my previous point about what about if you're giving SARS significant powers, which no one will argue that they need, what about setting some criteria? So that as a taxpayer, I can say to SARS, okay, you've issued an estimate jeopardy assessment. Whether that can be done logically or not is a different point. But you've issued an estimated assessment in respect of any of them. Have you considered these things that you have been asked to do with the information at hand? If you've got no information, well then I can't complain because I'm the taxpayer. But if I've given you information and you still issued a jeopardy assessment which has caused me significant harm, I would like to know that you at least applied yourself to these things. As regards an estimated assessment, all it has to be is that the information is incorrect or inadequate. Well, to who? What are you going to base it on? Information at hand. Normally these things will be done sensibly, but if you get into a circumstance where you're having a difficult time with a SARS official, this can be used in a sinister fashion, and the problem is you have to go to court to sort it out, and that isn't ideal for many taxpayers. So I think that there are narrow limitations placed on this power, and I refer you to section 164 there. I think this, in particular this and jeopardy assessments, would have been a great place for them to set out some criteria that a SARS official had to address before issuing, for example, an estimation of an assessment. If the taxpayer cannot submit an accurate return, the taxpayer and a senior SARS official may agree in writing to an amount of tax chargeable and issue an assessment based on that. That's something that we've seen in the past. And unfortunately, we deal with lots of taxpayers that don't have information at hand in order to deal with their affairs appropriately. The one thing that you may have noticed is missing is the withdrawal of assessment. Sorry, it sounds like the dog ate my homework excuse, but we really did have an IT crash the other day, and that slide disappeared from life. But there is a withdrawal of assessment. It's not earth-shattering. Jeopardy assessments. This is one of the ones that I wanted to spend a bit of time on. SARS may issue a jeopardy assessment in advance of the date on which a tax return is normally due if the Commissioner is satisfied that it is necessary to secure the collection of tax that would otherwise be in jeopardy. Now for us this is quite a startling power. The answer that you often get is, well, go look at England, go look at somewhere else, America, they've had this for a long time, it works fine. It may work fine, it may be a necessary power. As I say, I think that a lot of these things we've got one or two taxpayers to thank for them, but it is a significantly powerful provision. It gives the SARS a real arrow in their quiver that they can use against you if it's used inappropriately. And taxpayers need to be aware of it and they need to be mindful of it. The examples, and we'll see how it's utilized by SARS, but if a taxpayer tries to place assets beyond SARS reach, or taxpayers about to leave South Africa without satisfying a debt, these are the types of circumstances in which the Commissioner would issue a jeopardy assessment, and it's to avoid dissipation of assets, that sort of thing. In addition to the objection and appeal rights that you have, the taxpayer may take the jeopardy assessment on review, I know not appeal, just review, so it's a review process, to the High Court on the grounds that the amount is excessive or the circumstances that justify it do not exist. Fortunately, the reasons why the jeopardy assessment was issued must be included in the assessment. And again, I know I'm harping on it, but these could be any reasons. Because the jeopardy assessment section doesn't set out criteria that SARS must consider. It doesn't say they have to consider, is there a real risk of dissipation of assets? Has there been dishonesty? Also, and these are things that come to mind that one would take into account when you're dealing with the jeopardy assessment. Because it's not there, for the time being, and again until we get to court, they must set out their reasons, but their reasons are their reasons. And you can take it on review to the High Court, and as we know, review is a bit of a limited process. You've obviously got your objection and appeal rights in the ordinary course. SARS bears the burden of proving that the making of the jeopardy assessment is reasonable under the circumstances. So there is some good news for the taxpayer. Raising a jeopardy assessment is an invasive step and stands to be highly prejudicial to a taxpayer and thus controversial. I wasn't able to attend many of the former days, but I imagine that when the Constitution was spoken of, this is one of the sections that people have in mind as being perhaps a little iffy from a constitutional perspective. In a recent case, the Revenue and Customs Commissioner versus Ali in the UK, it wasn't quite dealing with jeopardy assessments, it was a freezing order, but the court looked at things, and these types of cases will be persuasive. What are the chances of the taxpayer's appeal succeeding? So the court will look a little bit at the merits, you know. You can't just fear of dissipation if you've raised a ridiculous assessment, start going and issuing jeopardy assessments. What are the merits of the case? Is there a real case? What is the risk of dissipation? Did you act urgently and did you use all of your remedies that were available to you? Those are some of the criteria, and I've no doubt over time, if this section withstands constitutional muster, we will build up some common law tests that the Commissioner needs to look at. So what is still covered under the old Act? I'm running a little bit out of time, I'm aware. 5 more minutes, okay. So I'm just going to raise a couple of things. There are still remnants of issues that are dealt with in the Tax Administration Act, in the old Acts. So if you're dealing with, as we are today, assessments, you can't simply look at the Tax Administration Act and say, that's all I have to read. The Fiscal Act that you are applying it to, you need to go and double check. And as an example, the Income Tax Act still has a definition of assessment there. The VAT Act, there are still portions of Section 31 because the Commissioner needs additional powers to raise an assessment for VAT purposes. For example, the vendor the person who was not a vendor but was raising VAT, the Commissioner still needs the power to raise an assessment in respect to that person. That doesn't exist in the Tax Administration Act. So the point to take away from that is that you can't be sure that everything you need to know is in the Tax Administration Act. You need to go and read the piece of fiscal legislation that you're dealing with and look for inconsistencies. If there are inconsistencies, the primary fiscal legislation overrules. So what happens if you get assessed? And I'm going to gloss over this. Who cares? You've been assessed, you've been told what tax to pay. Well, the first thing is, if you're not going to dispute it, you need to pay your tax. Okay? Under the Tax Administration Act, the tax is payable either on the date specified by Tax Act or on the date that SARS specifies. One of the details that assessments must contain if they do issue an assessment is the payment date. SARS may prescribe the method of payment, including electronically. If the SARS official believes that there are reasonable grounds that the taxpayer will not pay the full amount or will dissipate the asset, SARS may require that the full amount be paid immediately. Again, none of those guiding criteria are there. Self-assessment taxes, specific dates are mentioned in each of the acts. So the first thing is, if you get assessed or you put in your VAT return, you must start watching the clock because you're either going to have to make payment. The other thing that you may have to do is object or appeal if you've got a problem with the assessment. Under the Tax Administration Act, an objection to an assessment or decision must be lodged in a manner within the time period prescribed in the rules. The rules we haven't yet seen, they're going to be released by public notice, and we're working under the old rules at present. The last point I want to make is prescription. Section 79, as I mentioned, said that, and I'm talking income tax now, the Commissioner couldn't raise an additional assessment after 3 years had elapsed unless there was fraud, misrepresentation or non-disclosure of a material fact. Under the Tax Administration Act, SARS is prevented from issuing an assessment in the following circumstances. 3 years after the date of the assessment of an original assessment by SARS. Okay, so that's, when they talk about original assessment here, they're talking about the one you put in a return, no determination of tax, they give you a form saying you've been assessed. 5 years after the date of a self-assessment where a return is required, I love that. And 5 years after the case of a self-assessment where no return is required but you make payment. And they cannot issue additional assessments or reduce assessments where an amount which should have been assessed was disclosed in accordance with the practice generally prevailing. Practice generally prevailing changes, SARS can't go back and issue an additional assessment. So the last point I want to make. On the face of it, the differences are not significant between the two. We're dealing with the same animals that we are familiar with. Assessments, same types of assessments. You've got to be careful to assess the interplay between the Tax Administration Act and the Act that you are dealing with, which it supplements. There may still be fragments that deal with the assessments in that Act. I believe the case law is still relevant and must be considered. It's one of the ways that we are going to be able to guide SARS and to hold SARS to applying their minds properly in respect of sections which are really quite broad and don't give much guidance. As I say, worryingly few criteria set out in regard to fairly sweeping powers, in particular jeopardy and estimated assessments. Thanks very much. Are there any questions which I can try to answer?
Is there a roving mic? There we go.
Just in terms of prescription, if one has made an error and needs to resubmit a return, and it is in your favor, in the taxpayer's favor, would prescription apply? In other words, 3 years have passed and you've realized you've made an error, you need to resubmit the return, a corrected return.
I just want to check one thing. In the reduced assessments, there was one, I'm a little bit in between the two acts. I just want to check the answer to that.
93D.
93D. Yeah, so 93D allows them to issue a reduced assessment in circumstances where there has been an error. On the issue of whether or not that can prescribe, I would say that yes, because if you read the period of limitations in section 99, it says SARS may not make an assessment in terms of this chapter 3 years after, 5 years after. So if you, let's take for example an income tax error in your favor, you've put it in, you haven't asked for a reduced assessment in 3 years, then you go back and you say, oh, by the way, I'd like you to issue a new assessment. If I'm reading 99, it says SARS may not make an assessment in terms of this chapter, and then they give you the time periods.
The problem with that is the reverse is not necessarily true if there was information that they weren't aware of. So, do you know what I'm saying? If you let them know that there was information they didn't know, the prescription doesn't apply to errors in their favor, but is the same true for errors in the taxpayer's favor?
Yeah, I mean, if you're right. If they can say that the fact which was not disclosed was material, well, then they're going to be able to open an assessment. They're going to be able to say, well, I'm entitled to do so because you haven't disclosed a material fact. Again, there is case law, and it's often not relied upon, but it's very powerful as to when SARS can just say, oh, well, that's a fraud or that's a misrepresentation. So you need to go back to the old Section 79 on those issues. But yes, I think it is a one-way street in that regard.
Another question there.
Just to add on to that, where request for reduced assessment was submitted in terms of Section 79A and included, because it was 3 days before prescription date, ADR1, how does SARS first have to deal with a request for reduced assessment and then with the ADR? Or can they choose to ignore that request for reduced assessment and only deal with the ADR1?
Well, SARS needs to, are we talking about under the old Act here?
Yes.
Let me just jump to that. SARS needs to, if you are talking about an additional assessment, they need to, I mean, the question about the prescription is a proviso to that. So I would think that they would need to raise the additional assessment, or you would need to object if they are not willing to raise the additional assessment. So what I'm saying is, if I'm understanding you correctly, there's an error in the return.
Yes, and it's a request for a reduced assessment.
It's a request for a reduced assessment. Okay, so that should actually be dealt with in terms of 79A. I see. Yes. Sorry, I was looking at the wrong 79. Yeah, I mean, and what was it depends on what it was based on, to be honest. If it's based on an error, then they should simply issue the reduced assessment without having to. But, to be safe, you would probably lodge an objection and say there was an error. Yeah, do you want to?
Sorry, no, the law envisaged in both the new reduced assessment and the previous one that if it's the type of error that SARS doesn't dispute, it's an undisputed error, you need not follow the objection procedure. You can simply request a reduced assessment. If, pursuant to your request for a reduced assessment, SARS says we don't agree that it's an undisputed error, you only need to object then. So reduced assessment is to avoid having to go into the formal dispute resolution process. And that's both under the old law and the new law the case, except under the new law, it's a bit more clear that if it's undisputed, there will simply be a correction.
Well, I must just say, if I read it, 2 says SARS may reduce an assessment despite the fact that no objection has been. So to me, that gives them the power to do so. There's no subsection here which says, as a taxpayer, you can apply for a reduced assessment. So you could obviously contact SARS and request it in the circumstances, but there's no procedure written into the law for applying for a reduced assessment. And if you dispute an assessment, the traditional way is still an objection.
The taxpayer may request a reduced assessment, and there is a system. Therefore, if you're on e-filing, it's a very simple request for correction form that you need to complete. What the subsection 2 means is that even though you objected, and we discovered this is actually just an error that we don't dispute, we will simply issue a reduced assessment, notwithstanding the fact that you have objected. But the bottom line is, if you are comfortable that it's an undisputed error that only needs to be fixed through a correction, you don't need to object and appeal. It would be summarily be fixed, and there is a system, there is a process for this.
Okay, understood. So there is a practical process. There's nothing written into here that says there's an application.
You may request a reduced assessment, that's the process.
Okay, I don't see that. No, I agree with you, but there is a difference between the practical implementation and the way things work. Often you can contact the assessor, notify them, and they will issue a reduced assessment. If you look at the rules, though, if you look at the Act, the Act doesn't say you can request. I don't see that in the reduced assessment.
There's many things that SARS officers do that's not in the Act, so
Absolutely.
let us be happy with at least that sort of concession.
Can you give us a name?
Yeah. You might want to adopt a belt and braces approach so you don't get into a dispute on timing later if there was actually a dispute.
But
Sorry, can I just add to that? We live in a common law country. You don't need to prescribe each and every power that you have. Some powers are implicit. If the law allows a taxpayer to request a reduced assessment, that means that request must be entertained. You don't need to prescribe the procedure. You must complete form so-and-so. You must submit it within 10 days of discovering the default. That is not necessary. That process will typically be determined as a practice. You don't need to prescribe that in the law. There are many implicit powers in a common law country. In a civil law country, you have to prescribe each and every step, an empowering provision, and the authority would have no other powers than what is contained in that law. But this is not the case here. So if a right is afforded to a taxpayer to request something, it is something that must be processed. It must be dealt with.
I think we may be perceived as... Sorry, do you want to...
you know that old Afrikaans expression, ja nee? Ja nee. Ja, you're both right in the sense that you don't need a procedure and that sort of something, but remember it says undisputed. So you put in a request on the basis that it's undisputed. So I take the usual amount of time in getting back to you and saying, no, but it's disputed.
And you have
By then
time.
your objection's
Out of
gone.
time, yeah.
So absolutely, it's boots and braces. I agree with wholeheartedly. There's no requirement that there has to be procedures and all that sort of stuff. But I would agree. I would still put in an objection on the basis that it might come back and say to you, it is disputed.
All right, I think let's call it a day on that one. Any other questions? No. Right, in that case, let's adjourn for tea and be back at 3:30. Thank you very much, Andrew.
Thank you.